supplement, Propenomix Live. So today I'm going to be talking about, apart from anything else, Trumponomics, and intervention in the housing and mortgage market in the US. Unprecedented, really, in non-crisis times. In the deep dive, I'm going to be looking at several reports of note over the past week about the housing market in the UK and about the economy. And then in the macro section, I talk through the Bank of England Money and Credit Report, the PMIs for December, which tell us how the economy is doing in real time. My comment on there, the patient is just about alive, doctor. So that gives you a bit of a hint of what's coming. And the Halifax House Price Index and the meagre numbers they put forward for 2025. So these relevant reports I'm going to be looking at as a summary of some of these 75-page PDFs that you love the title of, you'd love to read, but you haven't got the time to do it. But also, I put my thoughts alongside them so they're segmented clearly, so we can talk about what's in the report, but we can also talk about what I think about what's in the reports. And there's only a couple of days left now for our workshop tickets, which I'll tell you about in a bit. But this week's quote, I always like to start with a quote, and this week's is, there are early and encouraging signs of a mild zombie apocalypse, where higher interest rates and minimum wages have combined to kill off struggling firms and leave the door open for new, more productive ones to replace them. And that's from Ruth Curtis, who is the chief executive of the Resolution Foundation, and that quote was from this month. And as I say, that looks forward to the deep dive. One of the reports we're looking at is from the Resolution Foundation. And it's overall, it's that time of year when you see lots of reports start to be produced about, obviously, the forecast for the year, future of the economy, current state of the economy, things like that. And then, of course, our specialist subject, how they pertain to the housing market, apart from anything else. But as the calendar creeps into the new year, it's a natural time for us to pause and tackle the biggest challenges that keep SME property businesses from achieving true and sustainable growth. For most, this boils down to two core areas. First of all, laying a bulletproof strategic plan for the next 12 months, and then finally cracking the code on their financial measurement, reporting and accountability. If you've ever felt lost in a sea of bookkeeping data, or if your productivity methods are falling short, it's time to switch from doing to leading and truly understand how your assets are performing. So please book in on the next Property Business Workshop with myself and Rod Turner, Thursday the 22nd of January, Central London, link in the show notes, and it's tinyurl.com/PBWNINE. Now, just quickly, one more plea for ongoing feedback as well, please. I had some great feedback on the supplement this week when a long-time reader informed me that she was finding things much easier to process since I started the iterative process of using AI to help me with some of my clarity and structure and also brevity. So thank goodness, please keep that feedback coming if you've got any. Trumponomics to discuss as always to kick us off. I don't see us not having to discuss the Donald until early 2029, if not beyond, if his leaving of the White House is noisier than it was in 2021. Everything else this time around has been bigger and better after all. So aside from the Greenland rhetoric, remember, even if just to calm your own concerns, take Trump seriously but not literally. Repeat after me. It's probably the most sensible thing I've heard said about him since he's been president again. There have been noises around further renegotiation on the pharma tariffs so that the US drug companies have more access to British money to buy their newer drugs. And then this £31 billion tech prosperity deal is also still hanging in the balance as it continues to be used as a weapon against us. The US Supreme Court is also set to rule on just how legal or not the imposition of unilateral tariffs is. It's just another chapter in this story rather than a final one, I'm sure. But where Starmer got body splinters on the Venezuela situation, he's been firm as a blancmange ever gets anyway, on the Greenland situation. Danish sovereignty reigns supreme. Trump wants something. He wants others not to have it, he says. He wants the raw materials underneath. He wants a mixture. I think he'd also love a big fat piece of land, the biggest acquisition for the US in over a century. And I think acquisition is probably the right word for me to be using as well. There was a classic Trump address that I just caught on Friday as the snow fenced us in here in Solihull. The hill did not look so soily, it just looked very white indeed. The generosity of the Venezuelans gifting these 30 to 50 million barrels of oil, although there will be a market price transaction here, we're told, of about $3 billion or so, depending on how many barrels there are, if reports are correct. And the big money that sits there ready to be made for the US oil companies. If they're going to put in the 100 billion to 200 billion, we're being told by the Donald that's not going to be any government money. That's all going to be private oil company money. If they're going to do that to repair Venezuela's rotted oil infrastructure. And really, this is where I know some people often say Donald Trump thinks a little bit like the mafia, but he obviously, as the strongest army and the strongest nation in the world, can provide a necessary level of protection for private companies to put money into regimes where there's political instability, apart from anything else. Of course, he's created that political instability for the moment in Venezuela, but that's not necessarily the point. The point is capital will go where it is either getting massive, massive returns so it can take massive risks, or it's got a level of stability. And if Trump can provide that guarantee, he's actually probably getting more value from the defence industry and the huge amount of money they spend on it than arguably anybody else has over the years. But it certainly sounds like drill, baby, drill, just not necessarily at home, obviously. So he turned his attention very much to domestic policy as matters as well this week, upsetting all sorts of corporate interests, as he has kind of threatened to do over the years, and he tends to do. Credit card companies shouldn't be charging more than 10% a year to give people a chance. That's what he said on Truth Social. 20 to 30% rates are a rip-off, and this affordability tour, as the calm commentators are calling it, is all a part of keeping the Republicans in favour for the midterms. Pretty straightforward stuff, really. Big Bill Ackman, who has moved up in my rankings these days of finfluencer / future goats to listen to, now Warren has retired back to chairman of Berkshire Hathaway, called it a mistake on X before he deleted the tweet. Don't upset the big dog, is the message. High-risk customers just won't get credit, is the argument from the banks, and you would expect that to be true. Unless the government subsidises this somehow, then terms and conditions will be being activated all over the place, cancelling cards, not providing credit to people where you would need to charge them more than 10% a year in order to make a profit. It's fairly straightforward. That is how capitalism works after all, and the American system is still just about capitalist, with a lot of interference around the edges these days. And good, some people will say predatory lenders will be stopped, but the thing is they probably won't be stopped, will they? Those people will be pushed into the black market, they'll be pushed into loan sharks, they'll be pushed into much, much, much worse forms of lending that find a way around any legislation that's introduced to do this. Those who've had credit problems in the past won't have the luxury of a credit card if they need a buffer, when lots of people use the high interest cards as a credit repair methodology apart from anything else. Now look, the credit card system is pretty much broken anyway, is my personal view on this. I use it extensively at 0% interest rates. That's been extremely lucrative really in the past few years, when at points I've had 0% interest for 3 years on day-to-day spending and discretionary spending as well of my own. Inflation has absolutely battered those balances before I've either transferred them across for a very small rate at 2 or 3% or something like that, and had another several years on interest free, or I've just paid them off, right? So I've won at that system, but at whose cost? Well, I would argue the shareholders of the bank, apart from anything else. Some would argue the cost of those less financially sophisticated who also participate in that system. In the real world, whether I participate or not is completely immaterial. Of course, the credit card market is net lending of billions of pounds a month, just in the UK, let alone the US. I'm not even a pebble in the pond, of course. But in aggregate, the offers at the top end will also have to suffer these 0% offers and things like that. They just won't be there because the profitable customers won't be there in order to subsidise the offers at the top end. So if you use a lot of 0% credit cards and you're in the US, then you might want to consider that. But I do have to make this point about market interference, right? This is market interference of the highest order. Markets do sometimes need interfering with, and much as libertarians wouldn't like to agree with this, that is really one of the primary roles of the government, right? When there's negative consequences, negative externalities for the whole of society, or for more people lose than benefit from something happening, that's when the government gets involved, right? And that might be the case with credit if we're comfortable saying there's a swathe of the population who shouldn't be allowed to get any credit. But as I say, my fear is they'll still go and get that credit from somewhere. It'll just be black market, and it'll be a lot worse for them than the credit card companies charging them 20 to 30%. I guess we're probably going to find out. But it does make you wonder how much American companies in general might be sweating right now and wondering who's next in the crosshairs. The investment funds, the hedge funds, the banks. Who is next? It isn't the first time that Trump has tucked into these sectors, although this is a bit more surgical and it seems a bit more real than some of his previous rhetoric, apart from anything else. But clearly when the Donald was doing his New Year's resolutions, there was clearly more on the slate as well. $200 billion purchase of mortgage-backed securities, or MBS, by Fannie Mae and Freddie Mac. These are the government-sponsored enterprises that do a lot of mortgage lending and are involved in the mortgage market in the US. That was announced this week to, frankly, simply circumvent the Federal Reserve. So what it strikes me as fairly simple. Trump's asked the question to his advisory teams, if we can't get the damn base rate down, even with stooges in the Fed, how do we actually get it down? How do we get the cost of mortgages down for people in America? And someone has answered, well, we'd do a bit more interference, really, apart from anything else. And this is probably obvious, guaranteed demand, right? What does that do? Well, it increases the price of the bonds. What does that do? Well, it squeezes the yields. Remember, the yields are the inverse function of the price of a bond. So as the price goes up, the yield goes down. And what does that mean? It lowers the price of mortgages. So not dissimilar to a move that I've suggested the Bank of England should take last year in an alternative to their disastrously expensive quantitative tightening strategy. So it won't surprise you to know that I'm in complete support of a move like this, within reason and within guardrails. The next question, though, is 200 billion. So what? What does that mean, right? 200 billion is an unimaginable sum of money for you and me. But what it is 1.8% of the total mortgage-backed security market. So not nothing, but not material. 66% of the volume of one single day's mortgage-backed security trading. Doesn't sound too bad. Nearly 10% of the Fed's total mortgage-backed security holdings. They hold 9.5%. So a significant slice on top of what the Fed already holds. 44% of the legal retained cap of Fannie Mae and Freddie Mac. So without changing the rules, this isn't going to happen again and again. But in these situations, the rules do tend to change. These are long-term prospects, not to be frittered around. The price drop to the lowest prices on these for some years is because this is a genuine and effective shock to the system. Like anything, however, if you keep chasing the dragon, the effect will be lesser and or the cost of the same impact will be much more significant. So, new homeowners, first-time buyers in the US will be delighted. This is an immediate saving of hundreds of dollars a month, potentially, for higher value mortgages and purchases. The government's stated target is to unlock those who are imprisoned by their lower rate that was locked in between 2009 and 2022, maybe even 23, and make it much less costly and difficult to move because they've got a big stagnancy problem at the moment. The vast majority of US mortgages are not portable. So overall, as well, this should stimulate the US house building and property services market and also retail spending linked to home improvements. So you ask yourself, well, actually, what's not to like then? Well, house price inflation at a time when many think US house prices are already significantly overpriced, well, possibly. Also, if rates bounce back and go back to beyond where they were, well, the taxpayer is ultimately carrying the can here. Market interference is also looked upon quite dimly as a rule in these sorts of markets. If this becomes anything like a regular occurrence, will the market players still participate in the same way? That creates a liquidity risk. What about the last one? Well, this is a crisis move when we're not in a crisis. In a way, similar but different to Biden draining the strategic petroleum reserve when oil prices took a walk, when Mr. Putin took a walk into Ukraine in 2022. All hands to the pumps at non-crisis times. The argument from Mr. Trump's side, of course, is that this is a crisis if ordinary Americans cannot move house. And having some sympathy with that view does seem reasonable. But then to politics, is it just meant to sound good or is it actually meant to work? Because these sorts of measures might need to go a lot further to make a real difference. It does sound good to the person on the street, of course, of that I'm quite sure. There's still talk as well of a stimulus check of $2,000 to Americans that need it. Don't know how we're defining that particularly, but it's about as populist as it gets, really, isn't it? A move like that coming from the tariffs. Yeah, great stuff. Clever in the way it's communicated to people, whether they understand all the underlying nuances of that and whether they understand the tariffs have caused some extra inflation in the US over the past year. Not necessarily if they see that $2,000 landing signed by Donald Trump. Very clever stuff, right? But very, very interventionist as well, directly, and stimulative as well, and inflationary, right? So it's not like the Labour Party aren't willing in the UK, going back to the UK, to interfere in markets. They've shown direct intervention via some fiscal policy in the last budget, freezing train fares, moving energy company obligation schemes out of the household bill and lowering energy bills directly. Again, I'm not necessarily against these moves, although using them to combat the inflation that they themselves caused by hiking employers' national insurance is ironic in a way only the British can understand. But I do get nervous, particularly if there's cause to question the economic credentials of the people in charge. And I would levy that over both sides of the pond, just to be clear. So one of the more fascinating Trump Watch segments I've done actually since the section started early last year. So we can go back to the hot cocoa on offer in the good old UK, which, let's face it, should be aggressively courting investment capital into its property market if there is not a safe home in the US anymore. You know, Blackstone shares dropped 5%, Invitation Home shares dropped 7% very quickly when Mr. Trump announced a ban on institutions in the US owning single family homes. Right, so probably worth just making the distinction. In the US, they have a lot of multifamily, they call it. So these are condos, as they prefer to call them, or apartments, blocks of flats, we would call them. There's a lot more of that sort of stuff, which is build to rent, which is institutionally owned. He's not tucking into that, but he is talking about Invitation Homes specifically, bought 50,000 homes across the US between 2012 and 2016, direct to vendor, below market value, spent big on refurbing them, rented them out in secondary locations where yields were really strong, and then floated on the stock market, which is why their shares were down 7%. It was absolutely Invitation Homes, bread and butter sort of stuff. But, you know, Blackstone were out very quickly to say, well, hold on, we've sold, we're net sellers of property since 2022. Well, of course they are, because the business model doesn't work anymore with the price of leverage. That's part of the point. They haven't said that bit, of course, but they own 0.05% of the stock of US single family homes, 1/20th of 1%. So you can see very, very quickly that one is not going to move the needle in any meaningful way. There is an area in Phoenix where they're talking about them owning 20% of build to rent stuff and new developments and things like that. And that's the number that's being pumped around. But really, rather than 20%, it's 1/20th of 1%. But it might help in the Sun Belt in Phoenix. Sure thing. Let's see. We haven't got any UK real-time property market data this week because it doesn't kick back in until next week, because Chris runs about a week behind with his data, and that's the first full and meaningful week of the year. And I'll be pumping that out next week when that's all in. So the macro scope, though, is back to its best as 2026 really got kicked off. The Bank of England Money and Credit Report was out, and the final PMIs for December were released. Halifax released their final index for 2025, which caused more fuss after their final number was a bit miserable. New year, same closing item, really. We still need to talk about the gilts and swaps, so that will be bringing up the rear as always. So money and credit reports, stable news, very low volatility in month-to-month number of mortgage approvals continues over the past 12 or even almost 24 months, really. A variance of over 500 approvals, printing 64,500 mortgage approvals for November 2025. Remember, this runs about a month behind. So the market seemed to keep calm while the budget was going on in the background, it seems. Remortgages grew by 3,200, getting back to 36,600 in November. And remember, that remortgages number by the bank does not count product transfers. That is just remortgages when someone has gone to a new lender. That's really been quite steady now for the past 2 years, after repair following a woeful 2023 for the mortgage lending industry and the housing market in general. The interest rate paid on new mortgages, which I like to keep an eye on, ticked up to 4.2% in November. The outstanding stock of debt is fixed at 3.9. So that spread between new debt and outstanding is now really, really quite narrow. And when they finally do cross, which I think might be at some point this year, we can be sure that on average, the market has really absorbed the normalisation of the interest rate. It might be next year before we do that, because of people who fixed in 2022 at higher rates crossover in 2027. Let's see. But I think it'll be towards the end of this year. But then we will have confidence the market has really fully absorbed normalisation, apart from anything else. But we'll still see some focused pain in the market this year, because people are coming off 2021 rates, if they had a 5-year fix there, which were the very, very lowest in all of the cycle, and they'll then go on to a 2026 rate, of course. So business lending also took a tick up, which is good news, still growing, 7.2% annually growth rate for large businesses, 1.9% for SMEs, but finally at least moving forward on a continued basis, although very slowly. And it's very clear from these sorts of figures that SMEs have suffered more from the pandemic and the resultant policies that have followed that would be congruent if you followed the stories in the media over the past week over the fate of pubs around their business rates, with the impending U-turn in the pipeline one more time. Large businesses are paying 5.64% on their business loans on average. SMEs are paying 6.18%. Households took cover and hoarded funds at the largest extent since January 2025, and were more in the money after selling some more assets in fear more than expectation of the 2025 budget. But the money supply is certainly moving forward, up 0.8% on the month. And I think it will find a home somewhere for sure. But the most watched number, that 65,000 mortgage approvals, is in line with a functional market that's about level between buyers and sellers, which might explain the relatively flat pricing that's been taking place. Although, as I've been arguing, it's a market of two halves, cheap and expensive. PMI is up next anyway. Sadly, the manufacturing PMI, the services, and therefore the composite index slipped back below their hopeful flash prints from late December. The 52.1 flash print for the composite and for the services fell back to 51.4 on each. Well, that seems a bit more realistic and is only congruent with the limpest of monthly growth, which is ultimately where I feel we are at the moment, and that is papering over the cracks of the pain in the private sector. Those prints were the tiniest steps forward from November's final prints of 51.2 and 51.3, so we just tiny bit inched forward for December, enough to stave off a recession. Pretty much is what we're saying. Probably, right? There's always a bit of monthly variance. So, what was the story? Lackluster growth in activity, soft expansion speed, lower than the average seen in the second half of the year of 2025. There was a bit of recovery in client confidence after pre-budget gloom, which went on over an extended period. Indeed it did, Rachel. But the story remains the same. Squeezed margins, sharply rising business costs, soft demand in major overseas markets, concern over growth in the economy in general, input prices rose by the most in 7 months to see the year out, and a pretty bearish report really overall, given that the PMI print was above 50. No danger of reaching that 50 in construction though. The print is so far adrift from the 50 handle. 40.1 was the print, absolutely catastrophic, but up on the 39.4 in November. But the second lowest reading since May 2020, the lowest being the month before. Civils were in a bad way at 32.9, housing at 33.5, residential housing, and commercial hit 42.0. So both of the latter moves were the greatest decreases since May 2020, once again. But the hope that exists in the sector at the macro level is concentrated on infrastructure investment in the near future. Business activity expectations for the year actually hit a 5-month high. So we would probably expect 0% or 0.1% growth month in December 2025, but we can legitimately be underwhelmed by the budget bounce that we were kind of waiting for. But look, it was December. It doesn't always behave like normal months. Some firms seem to give up about 70% of the way into the month. So of course you're not going to get mad GDP prints and things like that. We'll have to see what January's figures look like. Halifax rounded off the 2025 results for the major indices, and for the moment, until the ONS catches up with them, of course, which is about mid-Feb. The one that made the headlines, 0.3% price growth for the whole of 2025. They slipped 0.6% house prices in December, according to the Halifax. Their commentary, well, transaction levels were healthy. I agree. The market remains resilient. I'd say more like it's keeping calm and carrying on regardless. I'm not really sure how resilient it truly is. But people are motivated to get into houses ultimately. What's Halifax's best guess for 2026? A 1 to 3% rise in house prices, so let's call it 2%. Nationwide are at 2 to 4%, so let's call them 3%. I'm at 1.5%, so I'm underneath the forecast, which is fairly unusual over the last few years, but I feel like we've got a lagging problem with London's prices and the southeast prices apart from anything else, and there's not going to be any major improvements on that front in 2026 because the housing market moves slowly. It's like a big battleship, isn't it? It's a big old super tanker. So what's the Halifax regional roundup? Northern Ireland storming ahead at 7.5% up on the year. Scotland second at 3.9%. Wales at 1.6%. And they don't even mention the number in England, but if it was plus 0.3% overall, I think we can conclude English house prices were very flat in comparison to the other three, according to the Halifax. But they do comment on the English regional spread in pricing. Northeast at plus 3.5%, Northwest at plus 2.8%, and at the other end, London down 1.3% over the course of 2025. So no real new news there, and probably pretty reflective of the real world on the ground. Read an industry roundup for 2026, however, and there's plenty of positivity, and rightly so. Agents don't need a rising market to make money. Remember, they need willing buyers and willing sellers. More transaction numbers, the more money they make. And there seems to be plenty of both. So transaction levels look likely to remain pretty healthy and maybe even move up a little bit more. Moved up in 24 on 23. They moved up in 25 on 24. I think we'll see them move up again, possibly. But last but not least, the gilts and swaps Obviously, Mr. Trump's aggressive interference, as mentioned in the mortgage-backed securities market, pushed the yields downwards. And so the 5-year gilt opened at 3.961 yield last week and closed at a haircut yield of 3.837, the lowest one I can remember for a while. Ah, the joys of being tied to the US market when their yields move downwards. In the 30-year market, it had even more of a dramatic effect, opening at 5.269 on the week and closing at 5.118, 14 basis points down compared to the 12 basis point shaving on the 5-year. Happy days, right? Well, let's do a little recent history. This time last year, the bond markets were having a significant wobble. Labour was showing weakness. I know, imagine that, right? But 12 months ago, the 5-year gilt yield was actually 4.55%. The swaps were, as I've been saying for some time now, more nailed to the floor. The 5-year closed at 3.58% on Friday last week, with the discount now narrowing to only 25 or 26 basis points from the gilt yield. That discount has been about 36 basis points very, very steadily for about a year or more now that I've been commenting on. 1 month ago, the swap yield was 3.665, but 1 year ago, it was 4.147. But that wobbly period in early January when the bond vigilantes were wheeled out as the excuse / villain / macabre figure in the corner, whatever you want to call them, that's changed back now, realistically. And that didn't last that long in January last year. By February, it kind of repaired itself. So we had, at the end of the day, last week, a slightly shallower yield curve and lower yields. Overall, we'll take that, right? And the deep dive this week looks at a few reports of interest. As I've said, the first one, industry relevant, is the Savills UK cross-sector outlook for 2026. So as I say, I've summarised this with relevant commentary so you can see more easily what the report says and also what my own personal thoughts are. So hopefully this format is useful, but I'd love to get some feedback if you are listening to this. So, Savills Spotlight, UK cross-sector outlook 2026 and the Propenomix perspective. So cutting through the noise to see what the team at Savills are actually saying, they're calling for realistic optimism for 2026. So it's a little bit better than cautious optimism that's been talked about for 2025. They now want realistic optimism. After a turbulent 2025 where we saw more kite flying from the government than actual policy delivery, they reckon we're turning a corner. What do I think? I'm always wary when I hear realistic optimism. We need to look at the data at the end of the day. Well, they're right that the geopolitical stress has been a major driver. The real story for us investors is the spread between property yields and the risk-free rate of return, the gilt yield. If there isn't return, what's the point of bothering to put in the effort and the extra risk of bothering with property if you could get that return by sitting on your backside? And I'm not talking necessarily about myself and you. My risk-free, my premium above the risk-free rate of return is very large because we put a large amount of effort into the operation. I'm talking for institutions and big capital that we probably need to come into UK property, rental property, frankly, in order to save the market after the government has damaged it so very much over the past 10.5 years. And I'm saying that from a tenant's perspective. I'm not saying that from an investor's perspective, right? Probably doesn't help the investor, although it probably helps them provide a potential exit for their portfolio. But capital will provide lines of lesser resistance because effort and risk is not being adequately rewarded. So the macro view, is this the calm after the storm? Well, Savills forecasts a calmer environment for decision making as we move into 2026. They're seeing a 50 basis point reduction in interest rates. They see the base rate coming close to 3%, perhaps down to 3, but 3.25 is obviously their prediction as we're at 3.75 today. And they argue this will narrow bid-ask spreads and bring vendors back to reality. Now look, a base rate of 3% even is historically pretty normal post the year 2000. If indeed we do get there, and I'm not yet convinced about that, my own personal forecast is that we'll see 3.5% base by the end of the year. Let's not get too excited about cheap money returning because the days of sub 1% are gone until the next crisis, right? What matters now is whether banks pass this on to borrowers or whether they repair their margins that have suffered considerably since 2021. Savills mentions pent-up demand, but demand is useless without affordability. Cash flow is going to remain king here and how affordability is scored. So they then talk about comparative returns, chasing income, not just capital. So the headline figure is a forecast average total return of 7.8% per annum over the next 5 years. So this is total returns from properties. They're talking yield plus capital growth there. right? That's slightly up from their last year's forecast of 7.4. And the key takeaway here is the shift towards income returns. With capital growth likely to be muted until the economy really fires up in 2027, the heavy lifting is ultimately going to have to be done by the rental yield. So what about regional winners? Well, unsurprisingly, Savills are tipping the north to outperform the south in residential total returns. Absolutely standard for this stage of the cycle, they say. I'm not so sure about that, really. I don't remember them saying that back in 2015. But anyway, there we go. How about commercial properties? Well, they flagged them for being for institutional attention. High yields and low risk of new supply, because nobody's building them, make them a defensive sort of play. And then rural. Land is expected to see stronger capital growth than previously thought as the economy recovers from 2027 onwards. And a lot of this does align with what I've been saying in the Sunday supplement in the run-up to 2026. In a high-rate environment, you cannot bank on yield compression to make you rich. You need a hard cash yield today. The North outperforming the South is basic mathematics at work. It's why I've built my portfolio in the way that they'll play if they can cope with asset management. Remember, there were fears of turnover rents back in 2022, which have been allayed largely, and that's what led to a lot of the disposals in this sector from larger funds in the wake of COVID. But how can they replace that high yield return from property? They have to look elsewhere ultimately, or go back in to shopping centres that have been actively asset managed by SMEs and smaller players. Now, what about the commercial sector though? They talk about a gentle slope recovery. So forget a V-shaped bounce. Savills sees a slow grind upwards. They forecast commercial turnover hitting 55 billion in 2026 in terms of transactions. That's up about 10%, with prime yields hardening by a modest 25 to 50 basis points. So to give that number a bit of context, value of the UK commercial property market is about 1.3 trillion. So you can see there, about 4% of that stock is turning over each year. Strangely enough, very, very similar to the cycle of how much residential property turns over. 4%, another way of looking at that is 1 in every 25 years. A building sold once in every 25 years. Incredible when you think about that, really. Some people would point to stamp duty, saying it clogs up the number of transactions, of course. But there are other tax considerations and other considerations that aren't tax, of course, that affect things. So, occupational markets, well, the story here is robust, but for the wrong reason. There's no booming tenant demand. It's a total lack of new supply. Development viability is shot to pieces, so nothing's being built. And then there's the prime trap. Tenants are being incredibly picky. Prime buildings in secondary locations are struggling. You can't just buy a nice box in the middle of nowhere and expect to get a good yield. What are the sectors to watch? Offices, due to scarcity, is Savills' top pick. And retail is seeing low vacancy in dominant locations. So, Propenomix commentary on that. Well, the lack of distress in the market is quite fascinating. Lenders have been lenient, extending terms rather than foreclosing. We call it extend and pretend when we're being cynical. This means we haven't seen the flood of cheap deals that we might have expected. If you're buying commercial, focus on the tenant covenant. If the tenant goes bust, you're left with an empty box and a business rates bill. And in fairness, the valuers have managed the interest rate normalisation period very well, in my opinion, rather than causing panic and mass repossessions. But it's been very slow to adjust when really the adjustments in the bond market, particularly in late 2022, were very, very quick indeed. So credit to RICS for managing it in the way that they have. Kind of what they tried to do 2007-ish, but the system had gone too far and it broke at that point. We aren't at that stage today. So, what about the rural sector? They talk about food, fuel and solar panels, right? Because rural land is acting as a bit of a strategic hedge. Values have stabilised after dropping about 5.5% for prime arable land, but the north saw values rise. And the big story is, of course, the energy transition. Solar developers are paying rents of circa £1,000 per acre linked to inflation, right? And that's the ultimate diversification play. This is my Propenomix commentary here. £1,000 an acre for solar sounds attractive compared to farming yields, but remember, grid connections are a nightmare. Savills admit that the grid is the bottleneck, and anybody would who's being realistic. It's first ready, first connected now. Do not buy land assuming you can slap solar on it tomorrow. When's this going to be sorted? 2030? If you listen to Elon Musk, he remains absolutely convinced, as he has been for many years, that the sun is the answer to all of our energy needs. And then the residential sector, well, they talk about the supply crisis continuing at Savills. What do they see for 2026? 2% forecast upwards, but accelerating to plus 22% over the next 5 years. They're expecting a bottom-up recovery, and I myself have spoken many times of how the housing market in the UK does work bottom-up, not top-down, starting in the more affordable regions. So mortgages, the FCA has loosened the reins slightly, of course that's true, allowing lenders to be more flexible with loan-to-income ratios. And maybe this will unlock some capacity. And then rental reform, obviously the Renters' Rights Act is the elephant in the room. Savills believes that large landlords will absorb the regulation, while smaller indebted landlords will exit. Simple as that. And then development. Well, they rightly point out the government's 1.5 million homes target is impossible to meet. Housing associations are still scrambling to spend grant money before 2029, which might stimulate a bit of land buying. Now, my thoughts on all of that. Well, honesty on the housing targets, of course. I mean, Savills did release a report last year saying they thought about 800,000 was closer to 1.5 million. So it's not for the first time, but it was never going to happen. And they have professionally maintained that viewpoint throughout, rather than people like me who may have gone off the deep end at certain points saying, this is ridiculous. They don't know what they're talking about. They're not talking to anyone in the industry. Savills have found a much more reasonable way to say that, apart from anything else. And then what about the planning system? Well, we know it's been broken for a long time and developers are mothballing sites because the margins just aren't there, right? So Renters' Rights Act is a classic case of unintended consequences, driving small landlords out, reducing supply, pushing rents up further. Bad for tenants, really, but for those who stay in the sector and professionalise, the rental growth prospects are therefore strong. Supply is falling off a cliff. So what about the living sectors and the institutional wall of money? Very pertinent at the moment, especially after Mr. Trump's move against Blackstone and the likes in the USA. Build to rent, purpose-built student accommodation, PBSA, and senior living now make up 25% of all UK real estate investment. So it's a big number, right? 25% of the investment sector is in those fairly specialist niche sectors, right? So build to rent, remember, driven by single family housing, house builders are dumping stock to institutions just so they can keep their cash flow moving. PBSA, occupancy is wobbling in some markets. Students are struggling with costs. International recruitment is down, which we know, some of that visa sponsored, some of that other sponsored. And then senior living moving to a rental model is an interesting move in the market, of course. So my personal commentary on that part, well, watch the single family housing trends. This is just institutions buying housing estates that would have been sold to individuals, right? It puts a floor underneath the house builder revenues, which is helpful for supply, but it doesn't add any extra supply to the market, right? For the private investor, it means you're competing with pension funds for stock. You need to be smarter, faster, or look where they can't go. Now, I don't compete with them because I don't buy new build stock. And the vast majority of people listening to this are probably not buyers of new build stock for a multitude of reasons. The new build premium being a big one of them, right? But we have to go where we're smarter, we're faster, or where they can't go. Smaller value add refurbs, solving problems, the sort of stuff we do on a day-to-day basis. But yield on these projects are just unattractive to retail investors, and they don't contain an awful lot of edge above the risk-free rate, in my opinion, once they're up and running. So I don't know how long this party goes on for or doesn't go on for. So my verdict from the entire report in general, SAVs are painting a picture of a market returning to normality. The problem is really that normality now means higher rates than we've been used to, more regulation, and a desperate shortage of supply. Although the last bit we've certainly known for about the last 2 decades. 2026 will be a year for the brave, but only if the numbers stack up on day one. So what I'm saying to you is don't buy on hope and a prayer of capital growth, buy for yield and cash flow, survive then to thrive. In contrast, I took a look at the Resolution Foundation's first effort for 2026, their New Year outlook. Their strapline, early and encouraging signs of a mild zombie apocalypse. So don't get too excited or manage your expectations accordingly. But Resolution Foundation's New Year outlook for 2026 and the Propenomix perspective coming up. This is their annual tome. They're calling it this year of the mild zombie apocalypse. Not the walking dead, but the death of zombie companies that have been clogging up the UK economy for a decade. It's a dense read, so I've stripped out the waffle to get to what that actually means for us as investors. So the zombie apocalypse and productivity. The headline story is creative destruction. The foundation argues that the triple whammy of high interest rates, high energy costs, and rising minimum wages is finally killing off low productivity firms. These zombie companies, the ones that have barely covered their interest payments since 2010, are hitting the wall. Insolvencies are at their highest level since 2011. And I've been talking about this for years. Cheap money kept bad businesses alive. Now that money costs 5 or 6%, as we saw in the credit report today, reality bites. So we're talking about mid-market firms here, big employers of people, yeah? The M in the SMEs. They're in particular trouble in this department. So while economists might cheer for productivity growth, for those of us on the ground in property, this means tenant instability. If your tenant works for a firm that hasn't made a profit in 5 years, we need to worry about it, right? But long term, we do need this, because you cannot build a healthy economy on firms that only survive because borrowing is nearly free, right? They then talk about the labour market. Is this reallocation or is it just pain? Because as these zombie firms collapse, unemployment has ticked up to over 5%, as we know. The report frames this positively as a reallocation of labour from bad firms to good ones. It seems to me like they've been reallocated from employed to unemployed at the moment, but there we go. But they claim it's a turning point where we stop hoarding labour in inefficient sectors and start moving it to where it generates actual value. Now, let's turn that into a bit of real world stuff from the Propenomix perspective, right? If we took hospitality, and I pick on that very specifically because apart from anything else, we know it's being battered at the moment with business rates, and that's back in the news. It's been absolutely battered by the minimum wage, and not just the increase in the minimum wage, but the increase in minimum wage for younger people. And this is a direct result here. This is why we've got 16% youth unemployment now. Half of the jobs that were lost in 2025 were in the hospitality industry, right? About 125,000 odd jobs lost, yeah? Ultimately, lots of young people contained within that, and that caused part of the problem. But hospitality jobs are not economically particularly productive. They are largely low skill, although you do need the skill of being able to talk to people. Not in every hospitality environment I've ever been into, it seems, but you certainly should have that skill. And the hospitality industry itself would argue this is a critical part of building those soft skills for people who don't necessarily learn them at school, yeah, and helps them. And I worked in hospo between the ages of 18 and 25, and I think it did help massively with my soft skills and with understanding the mindset and the thoughts of the general public. And that's helped me in my businesses as time has gone on. Now I realise I'm probably slightly unusual in that respect, but it definitely helped me talk to people. It helped me with confidence. It helped me with, and these days, you know, social anxiety, mobile phones, all the rest of it, I probably don't need to go on. So it is damaging, but from an economic productivity perspective, it might look good. So we do need to be cautious, be careful what we wish for. What do we actually want here? I think the Resolution Foundation have found a pretty sterile way of saying people are losing their jobs. 5.1% unemployment is not a crisis, but it is a real big softening compared to the past 7 or 8 years. It puts a lid on wage growth, which brings me to my favourite topic, rent affordability. Tenants are nervous about jobs, they don't bid up rents. We're moving from a landlord's market to a more balanced one, so watch out for your void periods. We've already had some of that in 2025 as we adjusted from 2024. What about public spending? Well, it says that the brakes are on. The report notes that the state ballooned during the pandemic, which it did, and the subsequent cost of living crisis. But 2026 is marked as the year the state stops growing as a share of the economy. The government is attempting to shrink the deficit, which means the brakes need to come on for public spending. Now, Propenomix point of view on this is the political economy hitting the real world economy. The government has run out of other people's money. For property investors, this signals the era of handouts is over, so don't be relying on LHA rising to bail out your yields. We already know this government is ideologically opposed to it. If the state is shrinking, the safety net is getting holes in it. You need tenants who can pay from their own earnings, not from the state's. So what about household incomes? They describe it as the crawl continuing. And this is grim. Real household disposable income is forecast to grow by a pathetic 0.2% in 2026. Basically nothing, right? Because while inflation has calmed down, wage growth is lackluster and tax bills are rising. The fiscal drag, frozen tax thresholds, is quietly eating any pay rises that people do get. So 0.2% growth, let that sink in. If your rents are going up by 5% and your tenant's income is going up by 0.2, something has to break. Do bear in mind that's real. So that would be after inflation. But unless inflation was 4.8, that wouldn't add up to 5% anyway. So it reinforces my view for 2026. Don't budget for aggressive rental growth. If you push too hard, you'll just get arrears, right? Capacity to pay simply isn't there. I personally doubt we will even see the 0.2% growth in our HDI, and I'm concerned over an ongoing recession at the household level in that specific metric, because we're in a recession on that metric at the moment. And I think it's one of the most important metrics, if not the single most important macro metric that there is for property investors. If households haven't got it, how are they going to pay it, right? But remember, it's after inflation. You might want to look at nominal household disposable income, because that would, if you're looking at nominal rents, that's a better comparison. So I realise that's not necessarily a simple concept, but I will probably write and say more about that in the future. Poverty and welfare then. Is it a policy victory? Well, the report celebrates a triumph for 2026, but of course they do. Remember, the Resolution Foundation, if you don't know, their whole raison d'etre is to look after the mid to low income household. Yeah, so that's their primary concern. That's why they're funded. Yeah, so a sharp fall in child poverty predicted in 2026, mostly, of course, attributed to abolishing the two-child benefit cap. They project child poverty will be 3.5 percentage points lower than it would have been otherwise. Now, I can go into a very, very big and long rant about poverty and how it's measured and what it actually means in the real world, and the difference between absolute poverty, which I think should be absolutely everyone's concern, and relative poverty, which is just measuring for how many percentage points you are away from a median, which turns into be somewhat arbitrary. There are certain things that households in relative poverty have got that you just would not associate with the word poverty. It's such an emotive word, and it's very, very, very bad politics and bad economics, in my opinion. Right, but anyway, I did go into that rant effectively, didn't I? But it's a policy win, sure, but who pays for it? Well, the taxpayer puts more money into the pockets of lower income families. Technically good for the bottom end of the rental market, the LHA sector, but it's a transfer of wealth, not a creation of wealth. It supports the rent roll in lower value areas, but it doesn't solve the structural issue of low wages. It's also really and truly upset many working people who don't see the logic of paying people to have children. Now, this is really difficult because the birth rate in this country has absolutely cratered since COVID and the cost of living crisis, and we're nowhere near replacing. It's the first year, ultimately, where we're going to have more deaths than we are births in the UK. So then we rely on migration, and goodness knows what the future of migration is in the UK at the moment, and whether the debate can actually even divorce itself between illegal migration, which I think strongly very much needs to be stopped, and legal migration, which strongly needs to continue in order for us to be able to recruit the people that we need to into the industries we need to over the next decade or so, right? So huge differentials there. I don't think, well, it'd be interesting to know, drop me a comment if you do agree with that, or whether you think that's a load of nonsense and you really want to be on one side of the debate or the other. I'll be interested to hear from you. Although I'd prefer some of you were more respectful than you sometimes are in your YouTube comments, but you can't have it all, can you? I do it to myself, ultimately. So supporting rent roll in those lower areas, but not solving this structural issue of low wages, not good, right? Are people listening to the fact that 40% of the people benefiting from this are in work, in full-time work, and 60% are not? Not really, right? They're only seeing it as other people are getting money and I'm not, and I'm paying for it, right? And they're starting to understand these frozen tax thresholds and fiscal drag. So I've spoken in recent times of the issues of the fiscal drag and the higher taxation benefiting those on pensions and other forms of welfare. It's not a popular topic if you dare even breathe the word pension, but if you do receive net money, as in it's a benefit, it's net of tax, you're comparatively better off, as the workers get comparatively worse off, of course. And this ultimately has to affect the incentive to work, or the incentive to get classified as long-term unfit for work, might I controversially suggest, right? Show me the incentive and I'll show you the outcome. Charlie Munger, right? One of the best things he ever said. And he said a lot of good things. So what about demographics? They've described this year as crossing the Rubicon. And this is a stat that'll stop you in your tracks, right? This is this first year in modern times. It's happened before, but times of the Black Death and things like that, obviously. But deaths will outnumber births in the UK this year. Natural population decline only propped up by net migration. And this is a long-term deflationary force. This is why I see interest rates in the very long term being a lot lower than the current long-term bond market suggests, right? Japan have been through this decades ago. An aging, shrinking native population buying fewer houses and consuming less. No migration, house prices could be falling in real terms on a permanent basis, probably stay loosely the same in nominal terms and fall in real terms. Migration is the only thing keeping the Ponzi scheme of GDP growth and housing demand alive. Ignore the anti-migration headlines, the economy is addicted to it anyway, but how will the migration figures now readjust to the new world with fewer job opportunities in the UK, aside from anything else? So what's my verdict on the entire Resolution Foundation report? Well, they're painting a picture of a transition year. The drift is over and the pain of adjustment is here. The bad news, tenants are squeezed, incomes are flat, unemployment is ticking up. The good news, the zombies are dying, which might leave us with a better and more functioning growing economy in 2027. So what do I think? Well, it's a year to be defensive. Cash flow is your shield. Don't gamble on capital appreciation this year when the population is naturally shrinking, potentially, and incomes are stagnant. Stick to the fundamentals, keep your loan to value sensible, and for goodness sake, treat your good tenants like gold dust because they're about to become a lot harder to find. One final report summary brings us back towards conclusion this week. The Policy Exchange report released at the end of last year was a dense piece of work, pun intended, because it looks at building beautiful but dense buildings. Urban development is in desperate trouble in terms of viability, timing, and the likes since the new improved building safety and fire safety regulations. And I've spoken at this at length last year. This is critical for adequate growth of our cities economically, aside from anything else. So the Policy Exchange talk about smart density, and this is my perspective as well. So the Policy Exchange think tank has released this report called Smart Density, and for once it is talking some sense, although as always the devil is in the delivery. They're taking aim at the UK's obsession with tall buildings and argue that we've done density completely wrong. So they talk about the high-rise fallacy, debunking the myth that high-rise means high density, and they point out that London is actually one of the least dense capital cities in Europe, excluding the likes of Oslo. Paris and Barcelona achieve much higher densities without building 50-storey glass needles. They do it with consistent mid-rise blocks of 6 to 8 stories high. I've been saying this for some time. High-rise towers can be vanity projects for developers and councils. For investors, they can be wealth traps. Service charges in these glass towers are astronomical, the sinking funds are scary, and the running costs absolutely kill any net yield. Give me a red brick mansion block any day. It holds value, the roof is simple to fix, and the tenants actually want to live there. But can you even build them anymore if they're over 18 metres high? Well, what's the solution? Mansion blocks and terraces. So this report, according to the report anyway, the report advocates for a return to gentle density. These mansion blocks and terrace style housing, they want this to be the statutory default for urban densification. The argument is you can get the same number of homes per hectare as a tower block, but with better viability, cheaper construction costs, and less community opposition. So my commentary on that, well, from a viability perspective, this certainly used to stack up. Building above 10 stories needs complex engineering, cranes, and expensive materials. Building 4 to 6 stories is pretty standard brick and block work. Yeah, the margins are better, the exit strategies are clearer. You aren't reliant on overseas investors buying off plan, probably overpriced units. Plus mansion blocks that have that curb appeal that actually lets well. So SMART is this new acronym for them stands for sustainable, mixed use, aesthetic, responsive, and transport oriented. So aesthetic, they're arguing that beauty is the key to unlocking planning permission. People don't object to new housing, they object to ugly housing, they say. And transport, well, look, build where the trains are, right? Simple as that. I usually roll my eyes at the idea of beauty in policy documents, possibly because I'm not very beautiful, but it's very subjective and it usually means more expensive to build. But functionally, they are right? NIMBYs do block ugly developments. If you propose a Georgian-style terrace, you might actually get it through a planning committee. If beauty is basically a bribe to get planning consent or a proxy for support, then you've got to use it. What about street votes and local power? And this is the controversial bit. Yeah, the report pushes for street votes, allowing individual streets to vote on whether they want to densify, add a story to their houses or fill gaps in or whatever, in exchange for a share of the value uplift. So on paper, this sounds lovely and democratic, but in reality, it sounds like a nightmare. I mean, imagine getting your neighbours to agree on the colour of the fence, let alone a major redevelopment. But the principle of value capture, where existing owners get a slice of the profit, is possibly the only way to stop NIMBYism. If Mrs. Miggins at number 42 gets a 50 grand cheque because the street allowed a new development, she might stop objecting. In a world beset with viability issues, however, where does the money come from for this? What about the tall building ban? Well, the report essentially calls for a moratorium on tall buildings unless they can prove they're absolutely necessary. They want a mandatory tall buildings policy for anything over 60 metres, making it much harder to get them approved. What do I say to that? Good. As a portfolio landlord, I see the disaster of modern high-rise maintenance every day. The cladding crisis was just the start. lifts breaking down, pumps failing. These buildings are liabilities in waiting, and service charges are just unworkable and have grown out of control since COVID. A move back to traditional mid-rise construction is good for the long-term health of the UK property stock, unless the new buildings are superior to what's gone on before on a whole number of levels. And then how are they viable if that's the case? So, Propenomix verdict. Well, I think the whole report was a refreshing read, really, because it focuses on viability, which we know is the number one issue. You know, since planning is being solved, and I use that very, very broadly, but, planning is going in the right direction. Everyone can agree with that, yeah? You've got to then focus on viability. Should have been focusing on viability since the middle of 2024 because it was always going to be a problem. It was said back then, it's being said now. What's the bad news? Well, it relies on the planning system being flexible, which it currently isn't, and street votes are likely to be bogged down in bureaucracy. But the good news, it validates the strategy of buying in traditional dense urban areas, Victorian terraces and mansion blocks. These asset classes are being highlighted as the gold standard for the future. And I would agree with that, right? My take is we're stuck at 18 metres at the moment, so 6 to 8 stories is a pipe dream under current rules. If policy did shift this way, the boring mid-market stuff, your 1900s terraces and 1930s blocks, become even more valuable. And they're the model for the future. Avoid the shiny new towers, stick to what's worked for 100 plus years. Yield is vanity, profit is sanity, and bricks and mortar is reality. I worry the report is more idealistic than realistic, and with no mention of 18 metres in the whole report, the Building Safety Act, the Fire Safety Act, or any of the gateways, evidence would seem to bear that out. So they would probably argue that wasn't needed to be in the report, but how do you discuss building 6 to 8 storey buildings without the second staircase and all the massive issues there are above 18 metres at the moment? Anyway, as we get stuck into 2026 proper, the next property business workshop is filling up. Early bird ticket sales are in their last days of sale. It's actually the last day today for early bird ticket pricing. So get your tickets quickly if you're going to come along. We're going to start the year with a bang, discussing strategic planning and how to make the most of the next 12 months with some of our own methods and takes on productivity and time management alongside systems and processes. The other half of the workshop is about the most common pain point that we see in SME property businesses: accounts, bookkeeping and group accounting. This is about measuring asset performance, not how to use zero, but how to make the most of financial information. What should you be seeing every month? How should you interpret it properly? And how do you use it strategically to grow your business safely but quickly? As always, we have real life case studies about our own experiences, and we close with our no holds barred Q&A. Have you got something individual to consider? Well, get a VIP ticket and join us for dinner in a smaller setting with an opportunity to discuss any specific roadblocks or issues in your property business at the moment. Those dinner tickets are nearly sold out now. Well done to those who've booked on. There are 2 left as I'm saying this right now, so don't miss out. It's the best way you can get a substantial conversation with myself and Rod and other experienced property business people. So join us on Thursday, the 22nd of January 2026 in central London, tinyurl.com/PBWNINE. But above all, whatever you do, even if you're not coming to the workshop, remember to keep calm, always listen to the supplement and carry on. There will be opportunities abound this year and towards 2030 and beyond. The landscape's been set for a surefire bull run in property. Capital growth is set to remain slowish, as I've said today, but if you're in the right part of the UK, or you're targeting the right part of the UK, you'll probably be well looked after by the combination of that plus inflation. The big bull run is going to need a bit of runway first, although let's see what the FCA and the PRA are going to do around easing the lending requirements again. But let's have an amazing golden quarter together. In my opinion, it's a case of here we go. See you again.